All right, let's bring back our guest, Pierre Benoit Gauthier, Vice President of Investment Strategy at IG Wealth Management. Hopefully what we just had, little tech issues we had, doesn't bode poorly for the tech earnings we're going to see this week.
Hey, yeah, exactly. So I'm straight from my iPhone now. Sorry for the quality, but yeah, as I was saying, we've had a great run so far on earnings, and we'll have the real test this week. So it's a rough situation for the bears, considering that you got easier monetary policy, great results so far. The capex, the AI capex story is still strong and well with massive spending. That's driving both earnings and the overall economy up. And you got still an overarching, quite positive political backdrop with the fiscal stimulus still strong, with now this deal with China. So just a lot of positives out there.
We'll start with the first one with the earnings. What do they need? A great earnings from the five we're going to hear from this week, or what would people be happy with?
Yeah, it's strange because it used to be the story that these tech giants, these mag, I don't know if we call them Mag 7 anymore, but you know what I'm talking about, that they were very expensive and that was the bubbly part of the market, but that's quite not the case anymore. There's actually some good value for some of these stocks. So overall, the expectations are still pretty strong, but they have been shown as companies who are able to deliver consistently. And with Oracle leading the way with the new kind of AI investing fueled by debt, we'll see if these hyperscalers try to follow with even bigger investment announcements. So it's going to be interesting for sure.
Do you have any concerns with how they're doing that with the debt?
Yeah, it's definitely something that we're looking at, because it used to be a very reassuring story. The story used to be that, oh well, don't worry about this AI investing so much, since it's fueled by cash flow and by cash reserves. But if it switches to some kind of arms race with the debt over fuel, this could change the story around these stocks.
Now, with the bank cut expected from the Fed, are people factoring that in already? Will we see much of a change in the markets come Wednesday when they make the announcement?
Yeah, this one is completely phoned in. The odds as of this morning at 96% chance of a cut from the Fed. So it's not like we've seen earlier with where it was a bit tighter. Now it's widely priced in the market. So I don't think that we're going to see a big reaction from it. However, on the longer time frame, it just shows commitment from the Fed to these cuts, and we could have what could be the surprise is the end of the quantitative tightening. So if the Fed was to let go of its balance sheet reduction, that would provide some more liquidity for the market and would definitely be a boost to liquidity sensitive names, especially in tech.
Now, traditionally, fourth quarter is a good quarter. Any indicators that we could see a turn here? I mean, September kind of defied expectations. Could we see a turn for the fourth quarter at all?
Last time I was here, we were talking about seasonality, and I was saying that even though September seasonality is historically weak, when we have a strong September, it bodes well for the rest of the year. So we don't think seasonal factors will be a headwind at all. So far, everything is looking good for the fourth quarter, especially considering there's a lot of catch up to do, because it's been a year where active investment has been very, very hard to beat the index. So I think that a lot of managers will be happy to buy the dips, and we have seen it. Last week, after one bad day, we were a lot of people were ready to change their stance and change their views on the market. But once again, the dip buyers showed up, and we're back to new highs.
All right, I just want to sneak in one last question. I think we have time for it. Gold is looking at 4,000 as opposed to surging. Do you see that continuing, that trend?
Yeah, according to our models, we're charting gold against M2, against the the overall monetary volume. And for us, fundamentally, it would appear overvalued right now. However, when you look at this metric, gold actually never is at fair value. It's always undervalued or overvalued, and it's hovering around. So right now we see it as a bit overvalued, but we like the play in the longer term. The fundamental case still appears strong to us, but at some point the buying pressure was just too high, the momentum was just too strong, and we have to give some back at some point. But we don't see it as an asset that's ready to correct or a bubble ready to burst at all. We still like it on the longer term.
Okay, Pierre Benoit, thank you very much for joining us.
Thanks, and sorry for the technical problems.
Oh, not a problem. Already forgotten. Pierre Benoit Gauthier is Vice President of Investment Strategy at IG Wealth Management.